Liquidity ratio of Apple Inc. Current ratio formula current asset divided current liabilities as we have calculated for 2021 and 2022. The current ratio for 2021 Apple Inc. is 1.075 times, slightly more than 1, means that for every $1 in current liabilities, the company has only $1.075 in current asset. This implies a slight excess of current asset over current liabilities, which is generally considered a positive sign. It indicates that the Apple Inc. has a buffer of asset to meet its short-term obligation. The current ratio for 2021 Apple Inc. is 0.879 times, lower than 1, means that for every $1 in current liabilities, the company has only $0.879 in current asset. This implies a deficiency of current asset over current liabilities, considered a negative sign cause a company not able to meet short obligation. Quick ratio formula current assets minus prepaid expenses minus inventory divide current liabilities. Quick ratio for 2021 Apple Inc. is 1.022 times, slightly more than 1, able to meet the short-term obligation because of company has ability to convert liquid asset into cash. Quick ratio for 2022 Apple Inc. is 0.847 times, less than 1, not able to meet the short-term obligation because ability to convert liquid asset into the cash is low. Net working capital formula current asset minus current liabilities. Net working capital Apple Inc. 2021 Apple Inc. has a positive net working capital in 2021, demonstrate the company excellent business with current asset more than current liabilities and high liquid assets. Net working capital Apple Inc. 2022 has shown the negative net working capital as a result of having less current asset than current liabilities and low liquid asset. A negative net working capital in 2022 indicates a poor performance and unsatisfied business. Factors affect the current performance of the company. First, inflation. When the economy grows slowly, the inflation affected the company feel the impact with the losses purchasing power and risk their margins decline when price increase for inputs used in the production. Increases price a business will face surplus that have a trouble to liquid convert into cash that giving big impact to company performance handle the short-term obligation. Second, financial management. An efficient financial management approach that will ultimately decide how effectively a corporation performs financially must include budgeting, cost control, and cash flow management. Poor financial management can cause low liquidity problems, excessive debt, and low profitability by making it difficult to the firm to meet its short-term obligation. On the other hand, wise financial management enables a business to withstand economic storms. Third, internal factors. High-performing workers who help the business perform better and deliver better results. However, internal factors such as limited investment prospect and income source that result in increased debt have a negative impact on company ability to pay off debt.
Assalamualaikum, and for right now, I will be presenting question 2, journal. Petronas is a Malaysian oil and gas business. It is also known as Petroleum Nasional Berhad. It is crucial to manage Malaysia's oil and gas resources. Two factors that affect the effectiveness of one's company for Petronas company is the first one is dynamic of the global oil gas market. Several external factors that are present in global oil gas industry have a major effect on how effectively Petronas manage its assets. These components include volatility in oil prices and regulatory environment. Second factor. The second factor is technological advancement. The second factor is technological advancement and innovation. Being at the center of technical development is an essential for Petronas to maximize its assets management because the oil and gas sector primarily relies on technology. Following are important technology aspects that includes exploration and production technology and regulatory environment. Total asset turnover. The formula that we will be using is sales divided with total assets. For Apple Incorporated, their total asset turnover in the year 2021 has generated the revenue over $1.279 in sales, while in 2022, Apple Incorporated generated a revenue of $1.373 in sale. Ways to improve the performance of the company for that ratio. The company need to increase the sale revenue to enhance the total assets turnover ratio to keeping the assets so they can produce more production. First one will be pricing strategies. Evaluating pricing strategies to maximize sales revenues that appropriate the company products or service helps boost the sales revenue and optimize asset management. The second is asset investment. Considering the new asset purchase that give a potential good returns on investment, there are contributes to company generates more sales with the asset has been invest to maximize sales revenues.
Assalamualaikum. Today I'm gonna talk about question number three. The first one is debt ratio. The debt ratio show what a percentage of a company asset are financed by debt. A lower ratio is typically preferred because it suggests a lower level of financial risk. The debt ratio on 2021 is 28% and slightly increased to 32% on 2022. Although there has been a slight increase, the company to PM debt ratio has been below the industry average, which is 35% in both years, which is a good sign. This implies that the business use less debt to fund its operation compared to the industry. The next one is debt to equity ratio. The debt to equity ratio calculate how much of a company funding is provided by debt as opposed to equity. In general, a lower ratio is preferred because it indicates less financial leverage. The debt to equity ratio on 2021 is 53% and increased to 55% on 2022. For both years, the company to PM debt to equity ratio is higher than the industry average, which is 43%. Due to the company increased reliance on debt financing, there may be an increase in financial risk. The next one is time interest earned. Time interest earned is an indicator of how well the business can use its operating income to pay its interest costs. It is preferable to have a higher ratio because it shows a higher ability to pay interest obligation. Time interest earned for 2021 is 3 times and then increased to 5.2 times in 2022. For 2021, the company to PM has a lower time interest earned ratio than the industry average, which is 4 times. The company then improved and achieved higher time interest earned than industry average, proving greater ability to pay interest costs. Gross profit margin. Efficiency in production and pricing is shown by a high gross profit margin. Gross profit margin for company 2PM in 2021 is 65% and increased to 76.5% in 2022. For both years, the company 2PM gross profit margin is higher than the industry average, which is 60%. The company consistently outperformed the industry average in terms of gross profit margin, indicating that it is more effective at turning a profit on its output. Next, net profit margin. The net profit margin measure how much profit a company retain from its total revenue. A higher ratio indicate better profitability. In 2021, net profit margin for company 2PM is 24.5% and slightly increased to 25% in 2022. In both years, the company has a lower net profit margin compared to the industry average, which is 35%, suggesting that it is less profitable compared to its peer. Next, I'm going to talk about investment decision. The first one is the company has a good debt position with low debt ratio than the industry average. This indicate lower financial risk. Second, the company relies more on debt financing, higher debt to equity ratio, which could potentially increase financial risk. The third one is the company has strong ability to cover interest expenses as indicated by the higher time interest earn ratio. The fourth one is the company demonstrate excellent efficiency in production and pricing with consistently high gross profit margin. And the last one is the company net profit margin are lower than the industry average, indicating it may not be as profitable as its peer. The conclusion is, while having a strong debt position and good production efficiency, the company lower profitability compared to its competitors in the market raised a few concerns. The choice to invest should be based on a true assessment of all relevant aspects, including market trend, competitive analysis, and potential future growth. It is recommended to perform extensive due diligence before choosing an investment.